Welcome to today's Explainer. We're jumping right in to unravel a bit of a mystery today between two nearly identical ETFs to figure out exactly which one actually belongs in your portfolio. We're talking about QQQ and QQQM. These two funds track the exact same 100 Nasdaq stocks, they follow the exact same index, and yet they carry entirely different price tags. It's kind of fascinating, right? Well, today we're going to break down the exact strategies, the hidden mechanics, and the current technical levels you need to know to make the absolute best choice for your money.
Okay, let's quickly hit our roadmap for today so we can systematically settle this debate. We'll be covering 1. The twin ETF dilemma, 2. The true cost breakdown, 3. When QQQ actually wins, 4. Current market technical levels, 5. Avoiding the tax trap, and 6. Your clear action plan.
Let's kick things off with Section 1, the twin ETF dilemma, and figuring out which one actually wins. We're starting with a super interesting information gap in the market right now.
Imagine walking into a store and seeing the exact same products sitting there in two different boxes. One costs you $180 a year in fees, while the other costs $150. Unless you literally just love giving away free money, your instinct is definitely going to be to grab the cheaper one, right? But as you probably know, financial markets are incredibly nuanced. And as we'll see throughout this explainer, cheaper isn't automatically always better.
So moving on to Section 2, the true cost breakdown. Let's analyze these fees and see how this builds when we track the slow bleed of expense ratios over time.
The contrast here is honestly pretty striking. QQQ charges a 0.18% annual fee, while its younger sibling, QQQM, charges just 0.15%. Now I know what you're thinking, a 0.03% difference sounds completely insignificant. But look at the sheer weight of those share prices. QQQ sits up around $737 a share, whereas QQQM is way more accessible at roughly $304. That much lower entry point makes QQQM infinitely easier to dollar-cost average into if you're, say, contributing smaller amounts out of every paycheck.
And this brilliantly illustrates the long-term stakes here. Like I said, a 0.03% difference sounds tiny, but let's run the math over a couple of decades. If you have $100,000 invested and held for 20 years, that tiny fee gap costs you about $1,400. But if you have a $500,000 portfolio held over that same 20-year span, that seemingly microscopic fee gap will end up costing you over $7,000 in lost capital. That is literally real money just walking right out of your account.
So the crucial takeaway here for the buy and hold crowd is that on cost and accessibility alone, QQQM easily takes the crown. If your goal is to buy, hold, and just let compounding do its magic over the years, you absolutely want the lowest possible friction on your returns.
But wait, there is a catch. Section 3. When QQQ actually wins. Because liquidity really matters. Let's look at the hidden mechanics of the market to see why active traders still fiercely defend the older, more expensive ETF.
The ultimate deciding factor for market professionals is this massive liquidity gap. QQQ trades a staggering 16 million shares a day on average. QQM, by contrast, trades around 5 million. Now, for a regular retail investor holding long-term, 5 million is plenty of liquidity. But for active traders moving institutional size, that 11 million share canyon changes the entire landscape.
See, because of that massive volume, QQQ gives you incredibly tight bid-ask spreads and an extraordinarily deep options market. If you're out there selling covered calls, putting on iron condors, momentum trading, or heavily hedging a portfolio, QQQ is absolutely your go-to tool. QQM's options are comparatively thin and illiquid. That means if you try complex trading strategies with QQM, it's actually going to cost you more to enter and exit those trades through wider spreads, which completely erases those expense ratio savings we just talked about.
We can really distill this down to a super simple, memorable rule of thumb depending on your daily strategy. Passively investing for the long haul? Choose QQQM. Actively trading and need deep liquidity? Choose QQQ. It really is that straightforward.
Now, since both of these ETFs track the exact same index, let's pull back to Section 4, current market technical levels. Let's look at the real-time context of the underlying asset as of early August to see where we might be headed next.
Looking at the data for QQQ, it's currently hovering right around $722. The battleground is pretty clear. We're looking at immediate resistance sitting between $724 and $729. If the buyers can push and get a clean break above that $729 ceiling, well, that could open the door for a massive run toward our upside targets of $748 and possibly even $764 in the coming weeks. However, downside risk is always a factor. We have crucial support at $718,
If that level fails to hold, we could easily see a pullback down toward the 700 level.
So what's driving all this action? Well, we just saw a staggering $2.3 billion of institutional money flow into QQQ in a single day last week. I mean, that is serious institutional confidence. But if you look beneath the surface, there's a really heavy sector rotation occurring. Some of the former market leaders are kind of lagging behind right now. So for that bullish run to actually materialize, we desperately need the semiconductor and software sectors to step up to the plate as the market's new heroes to carry the index right through that resistance zone.
Okay, so you know the technicals and you know which ETF suits your style. But before you rush over to your brokerage app, we need to cover Section 5, avoiding the tax trap. This is a crucial behavioral finance warning for anyone who already holds QQQ in a taxable account.
Please, whatever you do, do not sell your QQQ shares simply to buy QQQM. If you do this in a regular taxable account, you are going to trigger a capital gains taxable event. Writing a check to the IRS for your gains is going to completely wipe out years or possibly even decades of those hard-earned 0.03% fee savings. Honestly, it's a massive mathematical own goal.
Instead, the smartest workaround is elegantly simple. Step 1, just leave your existing QQQ shares untouched. Let them sit there and continue to grow. Step 2, pivot and direct all of your new money, your future contributions, straight into QQM. By doing this, you instantly secure the lower fee moving forward, but you do it entirely tax-free because you haven't actually sold anything.
All right, we have covered a ton of ground today, from microscopic expense ratios all the way up to billion-dollar institutional flows. Let's synthesize everything into Section 6, your clear action plan on what to do next.
Here is your definitive 4-point action plan to make absolutely sure you are utilizing the best vehicle for your personal strategy. Number 1, if you're a long-term investor, go with QQQM to capture those fee savings. Number 2, if you're an active trader relying on options, stick with the deep liquidity of QQQ. Number 3, if you're already holding QQQ in a taxable account, remember, don't sell, just pivot your new money. And finally, number 4, keep your eyes glued to that 724 to 729 resistance zone as your short-term trigger for the market's next major move.
You know, understanding the nuanced mechanics beneath the assets you hold really is the defining difference between a casual participant and a strategic investor. So I want to leave you with this final thought. Based on your personal timeline, your tax strategy, and your trading style, which side of the aisle does your money actually belong on? Are you Team QQQ or Team QQQM? Take 10 minutes today, look at your portfolio, and audit your strategy. Thanks for joining me on this explainer, and keep learning.